Hey guys, welcome back to Tailored by Ambition. Today we're going to go over one of my favorite tools, and that's Yahoo Finance Equity Screener. So all you got to do is head on over to finance.yahoo.com. Right on the front page, you'll see screeners. Then you go down to Equity Screener. And today I'm going to show you a few of my favorite filters here. This is a great tool that will help you find the next stock that you're trying to trade or add to your portfolio. So here you can filter by market cap. That's going to be small cap is usually about 300 million to 2 billion. Mid cap is going to be 2 billion to 10 billion. And large cap is going to be anything above 10 billion. I have never seen mega cap, but I'm assuming that might be anything above 20 billion. Here under sector, you have the different sectors in the market. So if you want to diversify or dive into a particular sector, you can do so right here. So if you're looking for a REIT, if you're looking for some technology company, some industrial, energy, like oil, here's where you would do that. And then here under industry, you can dive deeper into that specific sector if you're looking for something very, very micro. Here under add another filter, that's where this tool really sticks out because you can dive into, I believe, like over 100 different cuts of data. So this is a very powerful tool. Today, the first one we're going to cover is PE ratio, and that's price to earnings. So that's basically how the price of the stock compares to the earnings per share. This helps you gauge if a certain company is under or overvalued. The higher the number on the PE ratio is, the more overvalued it probably is. And I can give you an example here. So let's say you want to trade the best company in the world, and that's Tailored by Ambition. And right now it has 1,000 shares outstanding. In 2020, TBA's profit was $10,000. So the first thing you got to figure out is how much was the earnings per share. So if Tailored by Ambition last year made $10,000 and it has 1,000 shares, that equates to $10 per share. If the stock price of TBA is $100, then the PE ratio would be 10, and you get that by the price of the stock divided by the earnings per share. So the PE ratio is going to vary by industry. Like tech is very high, especially as of recently. The S&P 500 historically has been trading with a PE ratio of between 13 and 15. And just to give you an idea, right now it's trading at about 25 PE ratio. So it depends a little bit of the industry you're going for, but it is one of the first indicators you can use to see if it's a good company. So one thing you can look at is that same company historically and also versus its competition. And that will let you know how under or overvalued it is. So let's add that to the filter. Let's see how this works. So let's say we're going to go for some small and mid-cap companies. Let's go for technology. And let's do a PE ratio of 20. So the cool thing is here, as you add filters, the number will get smaller as you're getting closer to the target company you're looking for. So let's say right now for companies that are small and mid cap in the US that are technology and have a PE ratio of greater than 20, there's 264. But let's actually look for companies with less. So remember, if it's less than 20, or the smaller the PE ratio, the more probability that it is undervalued, meaning it is possibly a good buy. So let's actually move this down to 10. We still have a lot of companies here. So let's see, just out of curiosity, 5. Okay, so let's see if we can narrow it down. Let's do under $50. No, greater than, so less than $50. Less than $30. Okay, so a lot of these might be junk companies, but let's take a look. So we see BlackBerry here. That's the only one I recognize from this. Eventbrite. Voyager. So Voyager is, I believe this is the crypto broker. Okay, so this is an over-the-counter stock. Yep, so this is definitely the crypto broker Voyager. So that's interesting. They're trading at $19. Okay, so yeah, they have no PE ratio because I don't know if they've been around long enough to have one, and nope, they have not. So they don't have a PE ratio yet. So, okay, so this is one of the bugs in the scanner. In this case, if it has an NA, it will pop up when you put less than. So that's something we got to work around. So let's try between 5 and 10. All right, here we go. So this is much better. So we got 27. Okay, let's just take a look at the first one, SunPower. Okay, so you see that they have their PE ratio at 10. Earnings per share at 226. Let's see if we can find float. No. Okay, so if you look here, you can see you're going to have two PEs, right? So trailing 12 months and forward-looking 12 months. So in these time periods, these are averages based on the previous 12 and the forward-looking 12, the upcoming 12. We'd have to look at their revenues because something must have happened in late 2020 that's causing it to adjust all the way down from 233 to 10. So what that might mean is that their price either went down or their earnings went way up. Yeah, and as you can see here, price went way down. So this might have been a split, or the price might have just gone down. So sometimes it's hard to gauge these PE ratios because, especially with the year we had last year with the lockdown, it threw off a lot of these ratios because they have big movements in price, and that tends to throw off these ratios. But yeah, a PE ratio of 10 in this case, even Yahoo Finance says it's near fair value. So here you dig into their financials and see how much the revenue cost them to make that revenue, how much profit they're making. So right here off the bat, you can see they were losing money in 2018, which might explain the PE ratio a little bit. And it seems that they are in profit, and the trailing 12 months seem to be in profit as well. So these are kind of some of the things you would look at after finding some of these companies. But yeah, you would probably pick one that you are more familiar with, because I'm not too familiar with SunPower, so I wouldn't invest with them necessarily. Okay, so for our next example, we're going to look at dividend yield. Dividend yield is pretty easy calculation, right? So let's say KMI, which is Kinder Morgan, is trading at $18.34. They pay an annual dividends of $1.08. What you got to do is you got to take that annual dividend and divide it by the trading price of $18.34, and that would give you 0.0588. Now, if you try to convert that to a percentage, you get that number and you multiply it by 100, and that would give you the 5.88%, which is the current dividend yield for Kinder Morgan. Okay, so let's look for US mid caps with a dividend yield of at least 5%. Let's see what we got. All right, so we have some energy companies, some finance holding companies, some oil. So here's a cool feature here. You have the PE ratios here, also the 52-week range. So one way to narrow down here would be looking at the companies that are on the low 52-week range and digging in deeper, looking at financials to see what is going on. Because if they're at support, meaning there's possibly a lot of buyers at the low end, it can drive these prices back to the average. So you can get money not only getting dividends, but on the company's journey back to the average price. So obviously you would want to do deeper research, but that's one thing you can do, as well as looking at the price to earnings ratio. So Top Glove Corporation, let's dive into this. All right, so it's been around since 2012. It had a catalyst late last year and then drove back down. So this is not necessarily a good thing. The average throughout its history has been where it's at right now. So that might have been a one-off event. So unless something else really tells you otherwise, I wouldn't consider this a good investment unless you're going to hold, unless the financials are good and you're going to hold just to collect that dividend payment. Because it has a very high dividend yield. But let's take a look. Let's open up Seeking Alpha. TGLVY. All right, so we pulled it up here on Seeking Alpha. We go to dividends. And let's see payout ratio. So payout ratio. So here's a red flag. Payout ratio is if a company is making $1 and the dividend it pays out per year is $1, that payout ratio would be 100%. So anything near that 100% mark is dangerous because it's very close to paying out the entirety of its profit. Now, when you have something like this means this company is taking out debt in order to pay the shareholders their dividends. So this is something that I would probably stay away from. But this is some of the due diligence that you should be doing when looking at these type of companies, or any company for that matter. All right, so let's take a look at Ares Capital. Seems to be a stable company. It's paying about 8% in dividends. Another thing I look at here is the analyst ratings. That's a pretty good rating here, 1.7. So a lot of the analysts that rate this company are saying it's possibly a buy. So that's a good sign. All right, so let's take a look at them in Seeking Alpha to get that payout ratio. Okay. Yeah, so there you have the 8.22. There's the annual payout. Right, so if they're paying $1.60, $1.60 divided by 1947 would give you that 8.22. So this pays quarterly, 40 cents, which that 4 times a year would be the 160. Now, they're paying 94% of their profits out as dividends, which is why that company is staying at the price level consistently, right? Except for this, whatever happened. Oh, well, 08, and then the lockdown. But then it usually reverts back to the average. So this one might be something to look at during the next correction or recession. It might be a good play to get into, as this company is not looking to grow the price, but seems to be consistently paying out the dividends. So let's look at dividend history here. Okay, so this company has been paying every quarter for the last 10 years. Doesn't seem to be growing the dividend too much, but might be something to add to your portfolio if you like it. But please remember, I am not a financial advisor. So do your due diligence before getting into any position, and don't invest with money you can't afford to lose. Don't be investing that rent money. All right, so the last filter we'll look at today, it's going to be something that would help you identify the short squeeze, which is popular nowadays. So let me explain real quick what a short squeeze is. It's what's been happening at GameStop, what's happening with AMC, and it's very popular nowadays in the Reddit community. When you're shorting a company, and this is usually hedge funds that have been doing it, and some investors, but basically it's the investor or the hedge fund betting that a company is going to go down in price for whatever reason. They, whether it's fundamentals or technical analysis, they think in the near future that company will be trading at a lower price than it is today. So they go to the broker and borrow X amount of shares and sell it in the open market at its current price. So for example, if that stock X is trading at $20, they think in the next month or whatever short-term time frame that they think it'll go down to, let's say, $10. So they're selling it. So they're borrowing it from the broker, selling it to the public at 20 in hopes that in a month they can buy it back for 10. Therefore, they can net a $10 profit per share. So there's a way to tell how much of a company's outstanding shares are being shorted. And these short interest reports are publicated about every 2 weeks, usually on the 15th and the last day of each month. So how you would see this is you go down to short interest and short percent of shares outstanding. So according to the Motley Fool, which is an investment company, they say that anything above 25, 30% is a possible scenario where a short squeeze may occur. Now, guys, this is very dangerous stuff. I'm just showing you so you guys can see, how these companies can be found. So in the future, if you want to get into something like this, you can. But this is a very dangerous type of investment because during a short squeeze, the price can be very volatile. So we'll go ahead and put 25% here. So that's 18 companies. Let's take a look. Okay, so you got Workhorse, you got Bed Bath & Beyond. All right, so let's take a look at Bed Bath & Beyond. It's trading at $27, almost $28, overvalued. Okay, so Bed Bath & Beyond's losing company, trailing 12 months. So it's technically estimated to be losing $1.24 per share. So if you go over to statistics, you got some good information here. But we'll go down to shares outstanding. So Bed Bath & Beyond has 106 million shares outstanding in the marketplace. And of that, 30% of that is supposedly being sold short as of May 14th. So remember, these reports come out every 2 weeks. So the next one is probably going to come out tomorrow. So these numbers might change. So, one getting into these positions, it wouldn't be wise to trade too far from the middle or the end of the month, as these numbers can change rapidly. But in essence, the short squeeze is there's a lot of shares, in this case, probably about 30 million shares that are owed to brokerages that these hedge funds have to buy back. So if they sold, for example, at $29, they're probably trying to push it down to buy back at whatever their target price might be. Might be 26, might be 25. So these hedge funds might try to team up and keep selling, therefore driving the price down. And a lot of what the Reddit community is saying, finding these type of stocks and then jumping together and trying to buy them up in order to drive the price up. Now, if enough people do it and the price does go up high enough, a lot of these hedge funds have to buy back these shares, even at a loss, because if not, the potential downside of that short position can be endless. Meaning this stock, in essence, can go up $100, $150, depending on how many shares outstanding, how much the demand is. So a lot of different factors that come into play. But it can drive the price up. And if, let's say, hedge fund AB sold 10,000 shares at $28, but the retail investors are coming in and pushing that price up to 100, they might have to close their position by buying back those 10,000 shares at that $100 price. And that, in a nutshell, is what's going on with the whole AMC, GameStop, and Reddit situation is going on these days. But there you have it. That's how to use the Yahoo Equity Scanner. It's a very useful tool. Let me know if you guys have any questions on it. I might pick out a few different filters and do a second video later on. If you found some of this stuff useful, please give it a thumbs up. If you know any friends that would benefit from diving into finances with you, share this video so they can learn how to use a scanner and start diving into this equities market and work towards that financial freedom that we're all looking for. Thank you guys for watching. Until next time.